Right, so we are on learning objective 2.4. We're going to do 2.4, 5, and 6 in this video and finish up this chapter. All right, so the first objective we are looking at is to record the completion and the sales of the finished goods. Okay, so I know I kept coming back up here and kind of referencing this handout. Okay, we're going to kind of be looking more over here in the finished goods area. Okay, so let's jump back over here. And so we've been accumulating cost into all these different jobs, and now they're complete, and then they are going to transfer through out of work in process into finished goods, and then eventually they'll be sold. Okay. All right. So the first one says the 644,600 cost of goods manufactured is the cost of all the jobs Smart Touch completed in 2027. Okay, so we are moving it from work in process to finished goods. This is like the aluminum coming off of the assembly line. It is in its package, it is ready to sell. Okay, it's done. For the most part, it can be sold right then. Okay, so that, if we're looking over here, oops, sorry, wrong one, you see right here, cost of goods manufactured, those two numbers are going to be the same. It is leaving work in process and it is going into finished goods. So we debit finished goods, credit the work in process. Okay, so that's the journal entry right there. Okay, then the next one, we're going to sell a job. So they tell us that we had jobs sold, Smart Touch Learning sales jobs with a sales price of 1.2 million. The cost of those jobs was 584,600. Okay. So this should look very familiar. If you look back, you think about when we were talking about inventory and we were selling inventory. Remember how we have to make two journal entries for every sale because we have an inventory item that we've got to get out of our inventory. Okay. So the first one should look really familiar. We're going to debit the accounts receivable, credit sales revenue. Okay. Before, when we had merchandise inventory, we would debit cost of goods sold and we would credit merchandise inventory. Remember that? Remember, I told you at the beginning, maybe of chapter 1 of Managerial, that finished goods act sort of like merchandise inventory. Okay, so now it's leaving finished goods. So let's jump back over here, and here we go. It's leaving finished goods and it's going to cost of goods sold. Okay, so we have to make two entries there. We have to make sure we make both entries if they ask you. Okay, so we can kind of see how this flows through these different accounts. We had work in process, we had transaction 2, 3, and 8. I believe 8 was the manufacturing overhead, and then 2 and 3 was direct labor and direct materials. Okay, so we made the entry for it to leave out of work in process, go to finished goods. Okay, not all of it left finished goods, only a portion of it left finished goods, and then went to the income statement as cost of goods sold. Okay. All right. So remember, we talked about manufacturing overhead in the previous video. So remember, manufacturing overhead starts with 0, ends with 0. Okay. So we made journal entries to put actual cost into the debit side of manufacturing overhead. And then on the credit side was what we applied, or we can call that our estimate. Okay. And remember, if you get a balance on the actual, that means you have more actual expenses than you applied. So you are under applied. That's in that little worksheet that I gave you. If you end up with a balance over here, then you are over applied. Okay. But it has to always end up with 0. okay? Because it's just a temporary account. We just sort of hold it there until we either allocate it to jobs, and then at the end of the period, we're going to take care of the under or over allocated, okay? So here, these numbers came in the previous video. We had those actual cost of 83,000 and we had applied or allocated 67,600. So we are under applied here, okay? It really does help if you will draw the T account when it comes down to this because I told you it's got to be zero, right? So I know it's right there, but I like to draw it out for y'all. And we end up with a balance of 15,400. So if you have this T account, you know that needs to be zero, then you know you need to credit manufacturing overhead, okay? Which is what they did right there, okay? Credit manufacturing overhead, and then we will debit cost of goods sold because that is cost that we did not add to those jobs, okay? Those costs go to those jobs that we finished and sold in the coming year. Okay. All right. So now you can see, oh, they drew that account out for me. Remember, we had all those transactions for all those actual costs. It was good for you to see me draw it out. That 584,600 was from transaction 11 when we adjusted the cost of goods sold for that under applied, that 15,400 makes that expense. Remember, cost of goods sold is an expense. It makes that expense go up, which will in turn make net income go down. Okay. All right. And so they give us a little diagram here, but I like the T account just because you don't have to get the water super muddy. You know it's got to be zero. So look at that and zero it out. So right here, that's the journal entry we made for under allocated. And then it's just the opposite. Okay. It's just the opposite when it is over costed, over applied, over allocated. Okay. All right. So now we're going to look at calculating the cost of goods manufactured and the cost of goods sold. All right. They give us a summary of all of these entries. These are great slides. I would have these out while you're taking your test. We'll talk more about the test the next time we meet. But here is a summary of all of those journal entries we've done in this chapter. Okay. And I really like that they give us a summary of the T accounts with all the journal entries. Okay. So you can actually see the raw materials, work in process, and finished goods, how it flows in and out of all of those. I don't have a cost of goods sold T account in my little spreadsheet that I gave you or my little diagram, but you can add it. You can add cost of goods sold there if you'd like. Okay. Here is a schedule of cost of goods manufactured. Okay. Do not attempt to do this one if you haven't done those T accounts. It's going to help you a lot to have those numbers in those T accounts. You know exactly what your direct materials are going to be. You know what your direct labor is going to be. Then we have our manufacturing overhead, what that was allocated. We get 591,600, though that's the total of these costs. Okay. Then the total manufacturing cost to account for, that is just the beginning balance, because that was last period's ending, added to what we added into work in process this period. Okay. So that gives us total cost to account for. They're going to take the in I'm sorry, ending work in process inventory. They're going to take that out to get cost of goods manufactured. Okay. We're getting close to being done with this chapter. So here you can see on the income statement, we have a little bit more detail here. We have that beginning finished goods, which started with zero. We had good cost of goods manufactured, cost of goods available for sale. Then we're going to subtract out what our ending finished goods is, and then we get cost of goods sold before adjustment because we had that under overhead that we needed to add into that. Okay. So then you can see that cost of goods sold, that was on a T account in a previous slide, 600,000. We have our gross profit, then we have all of our selling and administrative expenses. So we have this operating income. This is that multi-step income statement. It's just got a lot in there, okay? And then we have our other interest expense, other income and expenses. Then they have that number before taxes, then the tax expense, and then our net income. Okay. I'm going to skip over some of that. When we have kind of talked about how we can use all of these different theories in a service related business, okay? They're just not going to have raw materials, but they're basically accumulating billable hours to trace into jobs, okay? So they give us a quick little example here. Fox's salary and benefits total 100,000 per year, assuming a 40-hour work week and 50 work weeks in each year. Fox has 2,000 available work hours per year. Let me just tell you, if you're an accountant, you're probably not going to be working 40 hours a week. You're probably going to be working more. Okay. So that per hour looks great. If you do only work 40 hours, it's probably going to be closer to 60 or 70 hours a week. So then your per hour amount goes down. But that's how salaried employees actually works. Okay. They had following indirect cost estimated was 300,000 and they're going to use a predetermined overhead rate. So they can take estimated 300,000 of estimated indirect cost divided by estimated direct labor hours. So they would have $30 per direct labor hour that they will allocate to manufacturing. Sorry, not manufacturing overhead. They will apply that to each job. Okay. So they said they had 14 direct labor hours. They'll multiply that times 30 and they will tack on $420 to go to that particular job. Okay. So his direct labor, there's that $50 per hour, and then the indirect cost that gets allocated to that. Okay. So that's how much they would bill that particular client. Okay. I'm not going to do that. And that is all for this chapter. I will see you in the next chapter.